throughout the year and focusing on different topics in risk management. And today, our topic is the basics of crop insurance. The advantage of these webinars, of course, are we can be timely in our discussions, and these discussions are meant to be a little bit interactive. If you have questions joining us live on the webinar, or if you're watching the recording, be sure to follow up with our office, anyone here, and we can get back to you and help clarify any topics or answer the questions you may have. But what a neat opportunity we're providing here with these webinars of providing timely information on timely products for producers when they need the information the most. So crop insurance works well for our February discussion because for our spring crops, corn and soybeans primarily that we're dealing with, we have to make our crop insurance decisions for 2026 by March 15th. So we have a few weeks yet for our 2026 decision. We aren't going to spend a lot of time today talking specifically around 2026 plans or products, but give more of an overview of how the crop insurance program works, some of the basic terminology and ideas and concepts, and when they've been implemented, and what might work well for your operation, depending on what your operation consists of as far as acres, geography, on all of those different things. So I think with that, we're going to go ahead and get started. So, our clicker isn't working here. There we go. So our agenda for today, we're going to talk a little bit about the background of the crop insurance program, how it got started, some of the timeline features, and information about it. And then I kind of broke the presentation down into three groups. Crop insurance can be a very complicated topic, and we could dive deep into any one of these different discussions, but we're going to keep it pretty high level, and we're going to review some of the products available to purchase, what they're covering. We're going to go into the unit discussion and unit structure for crop insurance, and some of the choices producers have there and the advantages, disadvantages of each one. And we're going to wrap up with the APH discussion. APH is kind of what all of our guarantees, liability are based off of. And it's that number, that APH, that approved yield number that a lot of farmers like to know and talk about when they're discussing their crop insurance. So that's the agenda for today. And let's go ahead and get rolling. So specifically around the history of crop insurance, how did this thing get started? When did it become popular? So 1980 is kind of the key time period of when the traditional crop insurance that we know today got started. And it is a public-private partnership that started in 1980 where the federal government designed the program, sets the rules, and then they work with insurance companies across the United States to offer the products for sale through agents to the farmers. Okay, and so a few changes that have happened since that time period. Of course, products and the coverages have evolved over the years. In the late 90s, early 2000s was one of the biggest changes where we saw the biggest increase in participation were the creation of revenue products. Revenue products, of course, incorporates the yield with a price, and now we're insuring dollars, not just bushels. That really resonated with a lot of farmers, works very well with grain marketing plans, and we saw the participation in the program skyrocket after that. Nowadays, crop insurance is widely used, especially on the major crops, but also growing in some of our fringe crops and specialty crops as well. And we'll go through some of the acres and by crop type here shortly, or maybe even right now. So here's some acres by the crops. And you can see on the chart there, the red bars going across are the row crops. And you can see in the late 90s, early 2000, with the development of those revenue products, how our row crops really increased participation. And it's been pretty stagnant from then on, right? The amount of acres we plant of those crops every year stays relatively consistent. So it makes sense if we're buying if 80% of those acres every year are insured, that number should be pretty consistent, and that's exactly what we're seeing. You can see the bars on the graph that are growing the most are around our forage crops, our pasture, our hayland with a PRF policy, some specialty crops, and a few other things. but that growth in the forage, and specifically around PRF, has increased the amount of acres insured in the United States. Well, it's doubled the acres here recently compared to the more traditional crop insurance of the early 2000s. So pretty exciting that the program is expanding to include crops beyond our traditional row crops. When we look at the amount of dollars covered for the different types of crops that are insurable, you can see the row crops in that light green color there. They do vary as far as the liability, meaning the amount of dollars covered. They do vary each year, even though on that previous slide we saw the acres stay pretty consistent. Well, of course, that main driver behind the variability in liability is price. As price has increased, as yields have increased, we're going to insure more dollars. So we're seeing that in our row crops. They go up and down, but a vast majority, a heavy percentage of the dollars insured across the United States are in the row crops. Now, one thing that you'll also see here is, from 2020 forward, the growth of that red bar or part of the bar, and that's around our livestock products, our LRP, our LGM. In 2020, they increased the subsidy on the LRP and LGM products, greatly increased the participation. As more people are using those products, our liability by commodity type there for those livestock coverages increases as well. And you can also see the specialty crops and forage crops. Interesting, when we compare to that last slide, if we look back, the amount of acres in that light blue bar is the fastest growing segment around those forage crops. So we're insuring a lot of acres, but when we look at the liability, here are those forage crops, there's that orange yellowish bar at the very top. They don't make up a lot of dollars or a lot of liability. That kind of makes sense, right? If we look at pasture insurance, and you go out in the western United States, you're going to cover big chunks of pasture, lots of acres, but there isn't a lot of liability associated with it because it isn't a high dollar per acre crop. So just kind of some interesting statistics there of, even though corn and soybeans, wheat, cotton are maybe less than half of the acres insured, they are still about 80% of the dollars insured. Okay, another topic, and we'll talk about plans of insurance and products here in a little bit, but revenue and yield plans. We talked about how those revenue products increased participation in the program with their development in the late 90s. You can see the kind of yellowish bar there. The revenue products have grown in popularity ever since they came out. And so that is by policy type. This chart is by policy type, showing the revenue products, RP, RPHP, being the most popular products sold. That's kind of looking at the same thing. How about loss ratios? So one of the things I get asked a lot is, man, Lucas, I spend a lot of money on crop insurance and I never see losses. One thing that the government likes to do is they try to design the crop insurance program where it is going to pay out. Their goal is 110% loss ratio, meaning they're going to pay out slightly more claims than they're taking in on premium. Okay. So the farmer over time should see a net slight positive return, meaning the amount of money I'm paying in for my premium, I should be getting that back in claims. Now, maybe that timeline is a little longer than some people realize. And of course, some of us just don't realize the claims we've been paid in the past, or we forget recent history. But the program itself has been designed that way. We're actually seeing the loss ratios creep down, meaning if in the early 90s and 2000s, our loss ratios were higher, but our current loss ratio keeps kind of falling into that, under that 1.0 ratio, closer to 80% loss ratio. And so what that is causing the government to do is look at rating these products and potentially making them rated a little more favorably to maintain that long-term goal of a loss ratio of about 110%. So you can see the spikes in there, different years, the spikes being the loss ratio paid out heavily. One of the most recent history ones, 2012, the drought of 2012, paid out a lot of crop insurance indemnities across the Corn Belt. 2019 was another one. If you remember, 2019, it was an extremely wet year, so a lot of those claims that year were around prevent plant coverage. And then in the 2022, 2023, 2024 time period, we had losses in different parts of the country, but we also had high prices during those time periods. And so high prices and losses increases the loss ratio as well. How about the cause of loss? What's actually is getting paid out there? And very interesting chart. You can see the basic, the number one reason of crop insurance losses has to do with water, either lack of water or too much water. Probably not that surprising given the area we work in. That's what we're fighting every year. Either it's too wet and we can't get stuff planted timely, it's too wet and it's not growing right, or it's too dry and it's burning up out there. And so you can see the drought and high temperature, the red bar there. Look at 2012, you can see how much of the area, how many of those claims were driven by that dry year across the Corn Belt. 2019, kind of the exact opposite, right? A big blue bar there for excess moisture. On a normal year, you're going to have some areas of the country with drought, some with excess moisture, and of course the all-encompassing other category, which can be many things when you're trying to cover a bunch of different crops across the United States. So why is the government involved? Also a common question I get. The biggest reason is because a crop insurance policy can have a lot of dollars tied up in an area, and if the liability or the coverage provided was by a sole company and something happened in that area, the losses would be too catastrophic for that company to sustain paying claims and staying in business, right? When you think of the other common government-supported insurance product, flood insurance, when a flood comes in, it wipes out a lot of area or a lot of buildings and things in one spot. Crops is kind of the same way. If we get a drought, we get a hailstorm, if we get too much rain, it's going to affect a pretty big geography with that one event. And so that's why we need the backing of the government on these products to make sure that this program can be sustained and coverage can be affordable for farmers year after year. The insurance companies are the ones that do all the work out in the field. The government is behind the scenes working to provide reinsurance and backing for the companies so that farmers know that they're going to get paid if they have a claim, if they have losses, and also that the program will be around for years to come. Let's see here. I'm going to skip that one. So how about kind of the layout of the program? I talked about this before a little bit, but crop insurance works with a public-private partnership. So the public side of it, the government side of it, all is managed by the Risk Management Agency, or RMA. Okay, and they are a branch of the USDA, and so they're the ones that are setting the rules, looking at the rates, expanding the program, offering different crops. They're the ones of trying to make the program work across all the different crops nationwide in all the different states and geographies they're growing. Okay, I might give the RMA a hard time it seems like a lot of the time. In reality, the job they're doing is really hard, right? They're trying to make sure that a corn farmer in Laverne, Minnesota has adequate coverage, the same as a cherry farmer in Michigan or a guy growing oysters on farm-raised oysters in Louisiana, right? All of these are farmers. All of them are looking for protection, developing a risk management plan so they can be protected and maintain their farming operation for years to come. And the RMA is trying to write the rules to be fair for everyone involved all across the United States. The AIPs, or the crop insurance companies, they are the ones that take the rules and management of the RMA and train agents to go out and sell the products. So the AIPs are responsible for all the computer work, the information gathering, creating the forms, training, paying claims, have the adjusters in the field to work with the farmers. They are the the companies behind that. The independent agents out here are the ones that work with producers themselves. There's agents all across the United States willing to work with farmers and offer the crop insurance. And then, of course, we have the insureds out there. So what are the insured's responsibilities? From a true responsibility side of it, they're responsible for record keeping and retention and being truthful on the forms they fill out. And 99% of the farmers out there do a really good job of this, right? We could always all probably use a little bit better record keeping advice or tracking our information a little better, but for the most part, the farmers, the insureds, do a great job of providing information to the agents, up to the companies, to the USDA. Insured should also know their input costs, their break-even prices, because that can help them decide what levels of crop insurance to buy or what levels of protection do I need. When we meet with farmers, we show them different coverage levels. Every coverage level, of course, offers different amount of protection for different amounts of premium. If you can cover your costs or the part of your cost that you're concerned about with a lower coverage level, well, you should be aware of that so you can save your premium dollars. You should also understand what is all involved in the product you're buying and the risk management is providing. What is your tolerance for risk? Are you looking strictly for yield protection to protect against that weather-related loss? Are you looking for revenue protection? Do you understand how that works? The insured should ask questions of their agent to make sure they're understanding exactly what they're buying. All right, so that's kind of some of the overarching principles and information of the program itself. When we look at crop insurance, I always say it's a cyclical program. As you go through the year, crop insurance has different we have to be worried about different things at different times of the year, okay? And so we're going to start on this nice little chart here. At the very top, it says sales closing application number 1. So this is the sales period, and we are in it right now. So we are right in the middle of this. The March 15th, actually March 16th this year because the 15th falls on a Sunday, but traditionally March 15th is our sales closing date for our spring crops. What that means is if you, the farmer, are going to buy crop insurance, you need to have your application signed and completed by the 15th of March with what counties you want coverage in, what crops you want coverage in, and what coverage level do you want those crops at, okay? The other thing we need to know is, who is the owner of that crop? Is it a LLC, an entity, an individual? Are they married? All that information needs to be collected, recorded, and reported by March 15th. After March 15th, we go into kind of the planting season, if you will. So you'll see number 3, number 2 is acceptance. Number 3 is production reporting. You may be saying, why is production reporting in the spring of the year? I would say most of our production reporting is going to take place in the fall, but we do have until the end of April to complete that production reporting process. So if you are unsure of your bushels, you want to make sure you truck them to town, get them out of the grain bin before reporting, you do have time to do that. Also, if you're going into the next cropping season and you've added land, having a production reporting that late, the production reporting date later in the month of April allows us to establish a yield on that added land. Number 4, insurance attaches. With crop insurance, insurance will attach when that seed is in the ground. So that's, in our part of the world, April, May is when most of our insurance is going to attach when we're planting our crops. And then come 5 there is acreage reporting. Acreage reporting deadline is July 15th for our spring crops in our areas. And so what that means is if I have a crop insurance policy that I've written in March for corn and soybeans, when I sign up for that, I'm agreeing to insure all acres of corn and soybeans that I plant in that county. So by July 15th on my acreage report, I need to record all those acres I planted, where were they planted, and what date were they planted on. That process can be time consuming, but it's very important because that is what's going to establish our coverage for the year. and carry us forward into fall as we set the price and harvest our crops to see if we would have any potential claims. Premium billing is going to come out at the middle of August, end of September, paid by the 1st of October. And then we would say harvest starts and production reporting would kick in after that. Hopefully you guys are reporting your yields right after harvest, because that's when we're going to determine if there's a claim or not. The claims process, we're not going to talk a lot about in this webinar, but there are some specific dates that we have to have claims initiated by. So technically the rule states that within 15 days after harvest, if we have a claim, we should have one open with our insurance agent. Okay, so I would just keep that in the back of your mind as you're combining, and during harvest, there's a lot of information coming in, right? We have our monitors in the combines, or most people do. Maybe we got a grain cart with a scale on it. Maybe we're just hauling it to town or putting it at a bin. As we're harvesting, we should try to think in our minds, like, where is our yield coming in at, and communicate with your agent if you think that yield might not be where you expect it to be, or if it's below your guarantee. Because we can always turn a claim in, and if it turns out when we turn the claim in and by the time harvest wraps up, there isn't a claim, it is easy to withdraw. If we determine later in the year that we had a claim, it is very difficult to open up a late claim. So I would have, during harvest, maintain communication with your agent and communicate any potential claims. After harvest, we get into winter, and then, of course, our sales closing date comes up again the following March, and the cycle starts all over again. So that's kind of the way the crop insurance year works. We're going to get into kind of our first main topic here of plans of insurance. And Kay, do we have any questions coming in or anything? No, we are good. Okay. So let's start talking about plans of insurance. And there's kind of two different scopes of the plans of insurance we're going to look at. And we're going to spend most of our time on our individual plans of insurance. Okay, around 80% of all the crop insurance premium comes from an individual plan of insurance. And when I say individual plan, I'm meaning that I, the farmer, what happens on my farm, I'm protected with these plans of insurance. Okay, and so the main plans we're talking about when we say individual plans are, actually I'm going to say the top one is the revenue protection coverage, number 3 on the screen. The second most popular is our yield protection plan, YP, that only protects bushels, no price influence on the YP product. APH is a very similar product to the YP plan. It only protects a yield, but it's used with crops that aren't traded on the Board of Trade. And the last one there, number 4, revenue protection with the harvest price exclusion. This is not a real popular plan, and it's mainly because kind of that last 3 words there, harvest price exclusion. This would give you revenue protection if the price went down from spring to fall, okay? If the price would go higher, you would not be able to take advantage of that higher price in resetting your guarantees if you have that harvest price exclusion on there. The revenue protection, the number 3, is the most popular product sold. It provides yield protection because we do have bushels and our APH tied to it. And it provides revenue protection, meaning if the price goes down, we are going to be covered from using the spring price. If the price would go higher into the fall, all of our guarantees will reset using the higher price. So that is a very powerful product, very popular, and we would expect it to stay that way for many years. The 2 endorsements there, SCO and ECO. These are relatively new coverages, and in 2026, they are very popular because the subsidy on these 2 coverages now is 80%, meaning the government is discounting the premium the farmer has to pay by 80% on SCO and ECO. These coverages sit on top of our individual coverage and are county-based, but can be awesome ways to increase your coverage level. Not going to spend a lot of time on them here, but if you do have questions specifically on how to use SCO or ECO on your farm or how it may benefit you, I would encourage you to reach out and we can discuss it for your operation. The area plans are kind of the other aspect of the plans of insurance, okay? All those were individual. These are area. Area meaning it's not going to matter what happens on your farm. These are going to be a county-based coverage. And we have an area yield plan, an area revenue plan, and then margin protection products as well. Less than 2% of the policies nationwide are written off the area plan. They don't offer a lot of individual security. That's what makes them a little less popular. On certain ones, like the margin protection policy, you can combine with an individual plan. So there is some merit to those, and more people using that coverage. But the strict area revenue plans aren't real popular, but they are out there, so you're aware of them. A few of the other ones, we talked a little bit on the beginning about the growth in the forage insurance acres and pasture. Most of that has been driven by the PRF policy, pasture, rangeland, and forage is the acronym there. And those are indexed-based coverages. And so what that means is they divide up the United States into grids, roughly 12 by 12 miles in our part of the world, and they are measuring rainfall in that grid and determining a payout to you based on the lack of rainfall. So we set a baseline rainfall for the grid. We go through the time period that we insure. If our baseline isn't met, we have a crop insurance claim. So these work really well to protect against lack of rainfall, but also in areas that it's hard to determine a true yield, right? For pasture, it's hard to determine exactly how much grass is out there when we're not harvesting it. We're relying on animals to do the harvesting. And so that's where the PRF policy can offer protection on a specific peril, rainfall, without having to provide production records. We also don't need adjusters to use that policy. So that makes them real popular in the areas of the rural western United States to offer protection against drought or lack of rainfall, and also not have to have a lot of staff involved to make the product work well. The Whole Farm Revenue Protection Plan, WFRP, is it's a revenue-based product. It's basically insuring your farm of total dollars. It's insurance based off your Schedule F is one of the ways I like to refer to it. Not a lot of farmers in our part of the world using that. There's lots of reasons why, but where they are popular is with specialty crops that don't have great revenue protection type policies in place. So if you're growing a lot of vegetable crops or fruit crops, selling them at farmers markets, and you're looking for protection, this is an excellent tool for you. But if you're a corn and soybean farmer in the Midwest, probably not the biggest fit. And the livestock coverage is there. We talked a little bit about them. The LRP, LGM, and then DRP for the dairy side. These are price protection tools for cattle, swine, dairy that work really well for protecting price. But we're not going to spend a lot of the time on them today. We're actually going to have a separate Riskology webinar coming up probably in a couple months around LRP and LGM insurance, so be sure to tune in then. All right, so how does this crop insurance work? On the little bar here, we have our individual plans as our green bar on the bottom. They set our base coverage. We can buy that in 5% increments, so 75, 80%, 85% are very common coverage levels for our area on corn and beans. We have our optional units or enterprise units, which we'll talk about here next. And then that is protecting our individual yield. So that green bar at the bottom, that is our base plan. That's our revenue protection plan. That's kind of our meat and potatoes of crop insurance protection. That orange bar is that SCO coverage, and the purple bar is ECO coverage. They sit on top of my individual plan and can provide great protection up to 95%. Just a little bit different on how they work, using kind of a combination of individual APH and county final yields to determine a payout. All right, so let's get into an example of how these products work. It's relatively simple, but we're going to start with the easiest of them all with yield protection. So yield protection, again, individual policy, only protecting yield, yield being bushels for corn and soybeans, pounds for sunflowers, or pounds of sugar for sugar beets, for example, hundredweights for dry beans, whatever your unit measure is, but only covering bushels, no price involved. Okay. So the way that works, we would take our approved yield, our APH, times that coverage level, kind of that 50 to 85% in 5% increments, times our share, right? So if we are a 50-50 share, 2/3 crop share, that would come into effect too. But if our yield coverage level times share is our yield guarantee, okay? Now, for yield protection, we are going to incorporate the spring price of crop insurance to convert our bushels into dollars, right? So, because if we don't meet our bushel guarantee, the crop insurance company is going to come bring us bushels in a semi. They're going to send us a check. And so they're going to say, you're 10 bushels short, price is $4, here's $40 an acre, right? Coverage levels from 50 to 85%. Again, most common is 70 to 85% in our area. They may not follow market trends. And what I mean by that is if the price is going higher or lower from the month of February when that spring price is set, yield protection isn't going to adjust any guarantees for that movement in price. It is only going to protect your bushels. It does provide some replant coverage and prevent plant coverage automatically. You do not have to add this on. It is automatically included in the policy. And the prevent plant coverage does vary by crop, but for corn, it's 55% and soybeans is 60%. 55, 60% of your guarantee is what you're paid on your on any prevent plant acres. The losses on the yield protection policy are paid at harvest once you've determined how many bushels you've harvested. All right, so quick example. If I have a 200 bushel APH and I want to buy yield protection at a 75% coverage level, I am guaranteed 150 bushels per acre. Okay. If I get to harvest and I have harvested 143 bushels per acre, well, even where I grew up in South Dakota, that's a 7 bushel loss. I'm going to multiply that 7 bushels times our spring price. In our example, I'm going to use $5.90 for a spring price. Obviously, this example was ran a few years ago because we aren't anywhere near $5.90 now. But 7 bushels times our $5.90 spring price times our share, I'm going to assume share is 100% in this case, creates a $41.30 indemnity. Okay. The important thing to remember there is we only look at the spring price for yield protection. If I determine that I have a bushel loss, I take those bushels times the spring price, and that is what I get. Now, since I am not including any sort of fall adjustment or if price would go higher, the advantage I'm getting there is lower premium cost, right? So the yield protection policy can be an excellent way to protect bushels on your farm without spending a lot of premium. I did put a little matrix here, and claim matrix for yield protection work real easy because in this case, if I had a 200 bushel APH and our example on the screen, we're buying 80%, anything below 160 bushel, I'm going to get paid. And of course, it just depends on how many bushels below my guarantee that I'm collecting. Okay. All right. That was yield protection, probably the second most popular plan, individual plan of insurance sold. Revenue protection, RP coverage, is the most popular, so let's take a look at that. Basically, revenue just builds off of the yield plan, okay? So we still set our yield, our bushel guarantee, and then we add in price. Revenue protection is protecting against prices going up or prices going down, which is a key advantage over just the yield protection plan. We did mention about the harvest price exclusion. I'm not going to go through an example of that because it is less than 1% of the policies sold. All of the revenue plans and the prices we're going to talk about are prices determined from the Chicago Board of Trade, not the prices received by the producer themselves. So for RP, just remember it's off of the board price, off the futures price, not off of the price you've received locally for your crops. Okay, so the revenue protection plan, again, an individual plan, 50 to 85% coverage, does include replant coverage, does include prevent plant, just like our yield protection plan. Losses are paid at harvest after we've determined our final yield, and after that harvest price is set, which for corn and soybeans would be the month of October. So the equation we're going to use is very similar to that yield protection plan. As you see, our approved yield times our coverage level, and I took share out, but times share, and then we're going to multiply it by the higher of the spring price or the projected price or the harvest price. So we get the higher of the two prices to determine our final revenue guarantee. Our guarantee will never be below the spring price. Okay, so that's one thing when you're working with your bankers or trying to determine how many dollars I need covered. Yes, the number you set in the spring off of the February average will never be lower than that. Okay, it can increase if the price would go higher in the fall, but it's never going to be lower than your spring price. And these work great with a marketing plan since your coverage is being adjusted if the price goes higher. Okay, so if corn price would rally $1 from February to October and I lose bushels, well, I'm going to get paid at that higher harvest price. So if I've made some forward marketing plans, some forward marketings, I will be compensated at the higher price and be compensated if I can't find the bushels. All right, so I've talked a little bit about it, but just to be clear here, the projected price or the spring price, I'm going to use those two words and interchangeably, they are set during the month of February. And so we're recording this on February 17th. The spring price is being set right now. And the way they set the price for corn and soybeans, for corn, during the month of February, it's the average of the daily closes of the December futures contract. Okay, so every trading day in February, they take the close of December futures and average them together. For soybeans, same process, except they're using the November futures. So this, they're going to set the price during this. There's also something that I didn't include on the slide, the volatility factor that is set in the spring. That is set the last 5 trading days of the month of February, and also does drive premium costs. Currently, in 2026, where we're at, implied volatility in the futures market is very low, which is helping premium costs be lower this year when compared to last year. So we set that projected price in February. We'll set the harvest price in October. So in October, we'll take the average daily closes of the December futures contract to set our corn price. And for soybeans during the month of October, we're going to do the same thing with the November futures. If that price is higher with our revenue protection plan, we'll reset our guarantees and increase our coverage levels. And the nice thing about it, it will not increase our premium costs at all. All right, so let's go through an example here. Kind of the same example we had before. We're going to buy 200 bushel, or we have a 200 APH on our corn. We buy 75% coverage. Spring price, let's say, is $5.90. That is going to give us $885 of coverage at 100% share. Okay. Let's say where the price goes down in the fall. So we're going to drop 50 cents to $5.40 per bushel. If I combine 155 bushels an acre, I'm going to multiply it by our harvest price to determine our harvest value of $837. So our based off our guarantee in the spring, we were guaranteed $885. We harvested $837 of crop. That's a $48 indemnity. So that if you look at those numbers, we were guaranteed 150 bushels. We combined 155. This is the power of the revenue protection policy in that we are insuring dollars. So that 50-cent drop in price, even though we harvested more bushels than we were guaranteed, we lost enough price on every bushel to trigger that claim. So it's a very powerful policy Very good stuff. The way we kind of calculate that new trigger yield, if the price would have been 590, our trigger yield would have been 150 bushel, same as yield protection, right? Since the price went down 50 cents, the way we calculate our new trigger yield is we take our original dollar guarantee, $885, divide that by the harvest price, and that creates a 163.9 bushel guaranteed yield. Basically, I need more bushels at that lower price to get back to my original dollar amount guaranteed. So in this case, anything below 163.9 would generate a loss payment, which, since we combined 155, it was. Okay. Just like I talked about, it takes more bushels at a lower price to meet our guarantee. Now, what about if the price increases in the fall? So kind of our same example, 200 APH, 75% coverage, 150 bushel guarantee, $885 with that 590 spring price. If the price would increase to $6.30 per bushel at harvest time, so that October average comes in at $6.30, we reset our revenue guarantee with the $6.30, and that would create a $945 per acre of coverage. Okay, great deal. No extra premium involved. If my slides got a little bit there. So if I harvested those 143 bushels, the same as we did before, we're going to multiply those bushels times our harvest price to determine our harvest value, in this case, $901. Well, if our new guarantee is $945 and I only combine $901, obviously I have a claim in the tune of $44 per acre. Okay. Again, these prices are strictly coming from the Board of Trade average during February and October for corn and beans, not what you receive from your local elevator for your crop. So hopefully you can see the power of the revenue protection plan and why it's so popular. It's protecting us from loss of yield. It's also protecting us from loss of price, and it's protecting us if price would go higher and we're short bushels, we get to use that higher price. And so the claim matrix with the revenue protection policies you see looks a little different than the yield plan. The yield plan was very straightforward. If I was below my guaranteed, I got paid. In this case, if the price would go down, my guaranteed bushels go up, right? My trigger yield's going to increase because I'm going to need more bushels the further down the price goes. If the price goes higher, it's going to mimic the yield protection plan because I'm going to reset the guarantee at that harvest price. So I'm going to need to have a loss of bushels in order to have a claim if the price is higher. Okay. All right. Those are products. There are many different products out there. We didn't even hit on on hail insurance, some of the private products that are out there being sold, and we just kind of brushed on the ECO, SEO coverage. But if you understand yield protection and revenue protection, those are the basics. Those are the meat and potatoes of your protection plan, and you should understand those before expanding further into anything beyond that. All right, the next few sections are shorter, but just as important. So unit structure. Unit structure and crop insurance is kind of the basis on how all of our guarantees are set. Okay, how my coverage is going to really protect me in the case of a loss. Now, one way to talk about units is it's acres of the crop in the county. Okay, if I'm going to insure corn in County A, all the acres of corn in County A have to be insured. If I have corn in County B as well, I can choose to insure County B. I can insure it at a different policy, a different plan. Or I can choose not to insure it. Okay. So each county and crop is a different decision. But when I decide to insure it, now that becomes a unit, and we have a few different ways to separate out those units. Okay. So the insurable acreage of the insured crop in the county, taken into consideration in determining guarantees, is the definition of unit. We do use the legal description, kind of the section township range in our area of the world, to help determine unit eligibility and how we separate them out. All right, so our unit structures. There's 3 different unit structures we're going to look at. Basic unit is the simplest. Basic unit is the default unit if no other type is requested or if I only have one field of that crop in the county. Okay, a basic unit is a crop in a county at a certain share percent. So everything at that share would be under that same basic unit. So if I'm farming 100% cash rent piece of dirt and I plant corn in Rock County, that is one basic unit. Okay. So then we expand off of basic units, and the first one we're going to talk about is optional units. Optional units, we divide out the basic units further into individual sections. Okay. And we can also divide them out into irrigated or non-irrigated practices or organic, certified organic and not certified organic practices. Now, as you can realize, if I'm dividing out this crop into each section having its own guarantee or each irrigated, non-irrigated practice, I'm going to have better protection for my farm because now if I have a weather event or something happens in one section and not the other, I'm going to be indemnified. I'll have a claim to make me whole on that individual section. But of course, that is going to cost me more premium because the insurance company is saying if you have optional units, you are more likely to receive a loss, so the premiums are higher. Enterprise units are kind of the exact opposite, is they combine our basic optional units together into one guarantee for the county. All the acres, all shares of that crop in the county are combined for one guarantee. These are very popular in states where crop insurance is more expensive. It's a way to decrease premium costs because the insured is taking on more risk. All the acres I have of that crop in the county will be under one unit, an enterprise unit, and I'm taking on more risk, so they're rewarding me with a lower premium cost. Increased subsidy on the enterprise units as well. Before I jump, I would say the most popular unit structure in our area is enterprise units because of the lower premium cost. Optional units are also very popular for operations that have a geographic spread and want that protection for each individual section in their operation, or if they have if their yields vary greatly field to field, the optional units do a great job of that. Optional units are going to pay out more claims than enterprise units, and that is also one of the contributors to lower premium cost. Subsidy, this is the government discount, okay? Enterprise units are more subsidized than basic or optional units because they're rewarding you higher subsidies, lower premium costs for taking on more risk for the individual producer. So what structure is best? That is going to vary widely. I just a little map on the screen. You can see we have a few different ownership and share situations. Some are owned, some are cash rented, some are shared with different people across a 12 section area in whatever part of the country you want to be in. So what would I recommend for this guy? Personally, I'd say, you're relatively combined. I mean, a lot of acres in a fairly 3-by-4 mile area. Enterprise units probably work pretty well. Why would I say that? If a weather event comes in, it's probably going to affect each field pretty similarly. And having an enterprise unit, I could save some premium costs and still have good protection. Now, maybe this producer is saying, yeah, but look in that bottom corner, there's a river that runs through there. Maybe that is some low ground that has a tendency to flood out in certain years, or like a lot of river ground, it either floods or it's pretty sandy, so it burns up in dry years. He might be looking at, I need optional unit protection because I do have, different agreements. Maybe I got some irrigated, non-irrigated. I got some of this river ground. Optional units would allow for each of those sections to stand with its own guarantee. Okay. So as you look at your operation, how do you see it? how is my geographic spread? If I'm relatively close with all my fields, I think enterprise units is a good way to offer protection and save some premium dollars. But if you're spread out or have a lot of variability in soil type, yield potential, optional units are probably your best fit to give you the most protection going forward. All right, last topic for the day is APH. APH is a very important topic because we have to establish APH on every piece of ground we farm. We want that APH to be as high as possible because that's where our coverage level is going to be based on. It's what our premium is rated off of. It's very important to our operation. APH stands for, the acronym is actual production history. And so that's exactly what it is. When we insure a field and we harvest that field, we record how many acres, how many bushels, what was the yield, and create a database. That database, as it goes through the years, determines our guarantee for the farming operation. We want to do everything possible to build that APH and protect our farm. And we want to do it within the rules, of course. We can't lie on that. An insured's APH is a simple average of the actual history on what you've produced in that unit. Okay. Now there's a couple of different terms there. We have a rate yield, which would be the true simple average of your harvested bushels off of that certain field. And we have our approved yield, which will be trend adjusted, which we'll talk here in a little bit. Okay. We've hit on that next bullet point a lot. The APH is our key for establishing our guarantee. Our database of every field has to consist of at least a minimum of 4 years with a maximum of 10 years. And these are years that I have the crop in that section. So if in my farming operation, I have a field in a section that is rotated, corn and soybeans, I could have 20 calendar years of yields in that database, right? Because it has a maximum of 10. But if I plant every other year, some of those yields are going to get pretty old. Or if I have more crops than just 2 in my rotation, those yields are going to be older and older. So something to watch. It's not 10 calendar years. It's the 10 crop years that I've planted crop in that field. Of course, sometimes we aren't going to have 4 years. If I'm new to farming and I'm getting started for the first time, if I buy a piece of land or rent a piece of land, I might not have history in that section. There are procedures in place to establish a yield to start your insurance coverage for that piece of land, for that crop, for that county that you don't have any history in. The yields we use for that are called T yields or transitional yields. Transitional yields from no history to actual history. Okay. Each crop in each county has a certain T yield, and they're used in practices like this. All right. There's a few other things with APH to make sure that we maintain a high APH. The highlighted ones here are our most important. And you'll see these little acronyms on your insurance policy. YA is a very common one. It's a yield adjustment. Basically, what that says is if you have a database and you plug in a year that would be 60% or less of 60% of the county T yield, they're going to sub in the yield adjustment with 60% of the T yield. Okay. So let's go through an example on that. Let's say I'm farming in South Dakota and I've had some pretty good years, and then all of a sudden I have a drought year and I get a yield out there of 10 bushel an acre. 10 bushel an acre in my database would do a lot of damage to my overall guarantee for years to come. And by using that yield adjustment, I can keep that APH a little higher. The trend adjustment, the TA, is something that's relatively new. And this is a factor that comes in play and says, okay, the yields in your database, if let's say you have a yield that's in there that's 10 years old, the trend adjustment calculates if I had today's agronomic principles, seed genetics, and had that at my disposal back then, my yield probably would have been higher. And so they adjust up the old yields based on a factor that varies by crop by county. It's an awesome tool, helps increase our APH for a lot of crops. Okay, so here's an example database. You can see we got our years in there, our yields, our acres, and this would be an example of a typical database. And you can see in there our rate yield of 187, our approved yield of 213. Our 187 is the true actual yield for that field, but because of YA, because of the trend adjustment, we can use 213 as our approved yield to determine our guarantees. Okay, a few other things there. New producers, new persons. If I'm new to crop insurance and I'm adding a county, adding a crop for the first time, I'd be a new producer. I would get to use 100% of the county T yield in those cases in establishing the APH. If I have added land, I can use another T yield factor. CRP, native sod rules also have some different ways to establish APH on ground that hasn't been farmed for a number of years. One other thing is review process. So if we have a claim that exceeds $200,000, we are going to trigger a crop insurance review. The first thing they're going to review is your APH yields. What yields, what records do you have to support your guarantee that you're using? So that's why it's important to establish a good APH, but also make sure you maintain the records that support it. Okay, wrapping up here in summary, we kind of went through our crop insurance cycle. You know, our units, our APH, our products kind of go along with this cycle. Obviously, sales closing date, we have to determine our, the crops, the county, what unit structure is going to fit us, what products are we going to use to protect us for the year. Acreage reporting is going to help determine what unit structure I qualified for. And then when I report my production after harvest, is going to go in my database and set my APH for the following year. Okay. So in summary, what I would take away from this, hopefully you got a good baseline idea of how the crop insurance policies work, some of the information you need. But before you go see your agent for 2026, do some homework, know your cost of production, know your cost, and so you can start looking at the coverage provided by the policies in place to determine what coverage and premium combination is best fit your operation. Determine your risk tolerance. Are you willing to accept a little more risk and save some premium dollars by using enterprise units or a lower coverage level? Or is this a year where you need to protect as many dollars as possible with optional units or add-on products? Build your APH. High yields really help build your APH and maintain that high coverage level for years to come. Keep good, clean records in case we do get pulled for review and we don't have to worry about having our APH adjusted, and maximize that subsidy. Crop insurance is an awesome tool that is discounted by the government with that subsidy. By all means, use it, and I would encourage you to look at some of these add-on coverages, ECO, SCO, because of the added subsidy for 26, to make sure you're maximizing those dollars for your operation. With that, I'm going to call it quits on the basics of crop insurance. And Kate, is there any questions coming in? Guess not. Well, please, everyone, if you do have questions as you're looking through this or watching it, reach out to myself or anyone at ProAg. We'd be happy to help you. Thanks for joining our Riskology series, and we look forward to seeing you next month.